Welcome back to RegTalkUK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
And I'm Jamie.
So, if you felt like you experienced a bit of regulatory whiplash this past week, well, you weren't alone.
Not at all.
Our sources really paint a fascinating picture, don't they? Competing priorities, we've sort of dubbed it regulatory whiplash.
Yeah, that sums it up. You've got this sweeping deregulation for senior staff happening, running right alongside this really intense mandatory tightening of operational risk controls right across the retail sector.
Exactly. And we need to unpack that central tension for you today, because we're seeing this liberalization happening really quite fast for those at the top.
While the actual burden, fighting operational risks, cyber threats, consumer fraud, well, that's just getting heavier.
So the implications for compliance, for risk teams, they're pretty immediate, right?
Absolutely, no question.
Okay, so let's start at the top then, with the deregulation bit, the PRA stuff.
Right. The remuneration rules for senior staff, the Prudential Regulation Authority, the PRA, they've delivered some immediate and, frankly, pretty significant liberalization there.
Significant how? What's actually changed?
Well, the changes are quite transformative, actually. The PRA has slashed the mandatory bonus deferral periods.
Okay.
It's moving to a new period of just 4 years, which is, significantly shorter than it was before.
4 years. And overall?
Overall, they reckon they've cut the remuneration rules by approximately 70%.
70, wow. That sounds like a huge administrative reduction.
It is. I mean, for the bank's engine room HR, compliance, the teams that actually administer these rules, it translates into massive simplification.
Right, less bureaucracy.
Exactly. It's aimed squarely at boosting London's global competitiveness. They're allowing things like year one part payments, simplifying marginal deferral rates. Right. It really cuts down the overhead.
Less tracking, less vesting admin for those complicated bonus schemes. But this is where that core contradiction comes in, isn't it? The insight that should probably be ringing a few alarm bells.
Go on.
Well, you're looking at a system where, as one of our sources put it, UK regulators have made it faster to pay bankers their bonuses than to detect customers being systematically defrauded.
That's a stark way of putting it. And that speed of change is important context, too, because this liberalization, it's happening against a decidedly, shaky macroeconomic backdrop. The ONS confirms the UK economy is really sort of stuck in the slow lane.
Absolutely. The figures were pretty lackluster, weren't they? Only 0.1% GDP growth in August.
And July revised down to a contraction, minus 0.1%.
Yeah. And services growth was just flat, 0%.
And this stagnation, it's combined with increasing pressure on consumers. Unemployment's up to 4.8%. Inflation's still sticky at 3.8%. These figures, while they're fueling expectations among traders for a December interest rate cut, aren't they? Maybe down to 4.75%.
So if you're a risk or compliance professional listening, you've got to balance this perceived regulatory easing on pay with rising operational and market volatility risks. And speaking of market risk, we have to mention that warning from the IMF, don't we?
Indeed. The World Economic Outlook, they issued a specific warning, quite pointed actually.
About the AI stock rally.
Yeah, saying it shows uncomfortable parallels to the dot-com bubble back in the late 90s. You've got the highest ever concentration of value in the S&P 500 right now.
Dominated by just a few AI-linked firms.
Exactly. And that underscores a potential systemic vulnerability lurking there, even while compliance teams might be feeling pressure to cut internal costs because of the remuneration changes.
Right. So that economic and market volatility feeds directly into our next focus area.
Yeah.
The intensification of operational risk.
Yes. Let's transition from that elite liberalization to the devastating crisis of consumer fraud.
Okay. The FCA review into romance fraud this week. It really highlighted institutional failure on a, frankly, shocking scale.
Shocking is the word. Romance fraud cases rose 9% last year, costing victims a massive $106 million.
And the average individual loss?
11,222 pounds. A huge amount for ordinary people.
And the details of the institutional failure, they're what really stick in the mind, I think.
Tell us about that specific case.
Well, the FCA reviewed one case. A victim lost 72,000 pounds. Via, get this, 403 undetected payments over a single year.
403 undetected.
Undetected. The firm involved actually admitted it failed. failed to identify that sustained, completely out of character activity.
Which is just staggering. And what's fascinating, or perhaps chilling, is the psychological complexity here.
How so?
The FCA noted that 42% of victims actually conceal the true reasons for their payments. They're often completely, as the FCA put it, under the spell of the scammer.
Right, so it's not just about simple transaction monitoring.
Not at all. This goes way beyond simple rules-based blocking. It demands, well, proper AI-level pattern recognition systems from retail banks, focused on behavior, not just transaction size.
The expectation for detection has shifted then, fundamentally.
Absolutely. And the FCA demands are clear. Better detection, better monitoring, enhanced staff training, and, crucially, better aftercare to help, break that spell.
Okay, and the regulatory pressure isn't just on fraud failures, is it? Cybersecurity is equally sort of non-negotiable.
Definitely. And the capita fine this week serves as a really brutal financial counterpoint to those remuneration cuts we talked about.
The ICO fine.
Yes, the Information Commissioner's Office. A colossal $14 million fine for capita, split between the People and the Pensions Division.
$14 million. Wow. And what was that for?
A preventable data breach,
Yeah,
affecting 6.6 million people, including highly sensitive data, criminal records, financial information, really serious stuff.
Yeah, and the government response was pretty swift too, wasn't it?
Very swift and pointed. A ministerial letter has gone out urging board directors to treat cyber risk as a top-level priority.
What did it recommend?
It specifically mentioned using the Cyber Governance Code of Practice, signing up to the NCSE's early warning service, and, really key for managing supply chain risk, mandating Cyber Essentials certification within those supply chains.
Right. So that's a clear top-down compliance mandate. No wiggle room there.
None at all. It reinforces that theme. Deregulation, maybe for elites, but intensification for operations.
Okay. So moving from today's operational risks to tomorrow's financial landscape, let's look at digital innovation.
Right. It's clear the Bank of England is keen in developing the UK's sort of multi-money ecosystem. They're focusing on AI, distributed ledger technology, DLT, and quantum computing in their tech strategy.
Sounds ambitious.
It is, but their ambition is, well, it's heavily tempered by caution, particularly around stablecoins.
Okay. What's the plan there?
The BOE is consulting later this year on requirements for systemic sterling-denominated stablecoins. But the key detail, the real signal of that caution,
Is the proposed individual holding limits.
exactly. They're proposing caps,
Right.
somewhere in the range of 10,000 to 20,000 pounds per person.
10 to 20,000, that seems restrictive if they want stablecoins to take off.
Well, that's the point, isn't it? It's the ultimate regulatory hedge. One observer put it quite well. Breeden wants stablecoins to succeed, but not too much.
Ah, okay. Why the limit then?
It's designed specifically to prevent a runaway success, to stop a mass conversion into stablecoins, causing a credit crunch if too much commercial bank money suddenly flowed out.
Right. So the central bank is managing the risk of disintermediation for retail banks. Carefully.
Precisely. Cautious ambition is the phrase.
Okay. And on the investment and infrastructure side, we are seeing some real-world movement towards tokenization, aren't we?
Yes, the Digital Securities Sandbox, the DSS, that's now officially launched.
Right. The DSS, that's the Restricted Regulatory Environment for Testing Tokenized Securities.
That's the one. It's got 15 participating firms, including big names like HSBC and JP Morgan.
And they're moving to real-world transactions.
Yes, under a capped size for a 5-year development period. It shows the UK's commitment to staying at the forefront of digital asset infrastructure, but critically, under strict, measured regulatory control. Again, that cautious approach.
Yet there seems to be a final policy hurdle creating a bit of tension in this digital space.
Ah, yes. Open finance versus market access for challengers.
Right. So the FCA is pushing ahead quite fast with open finance, partnering with Radium, tech sprints coming up on mortgages, SME finance.
Yeah, aiming for a roadmap by March 2026. That looks like rapid progress on data sharing.
But contrast that with Revolut.
Exactly. Their UK banking license is still stalled after 14 months now, due to regulatory concerns over their global risk controls.
So that stark difference really highlights that issue of, well, different rules for different players, doesn't it?
It does. It depends on their scale, their regulatory maturity, their inherent risk profile. And that's a key factor for incumbent retail banks watching their potential competition,
Definitely something to watch. Okay, before we wrap up, let's just run through a few final compliance catch-up points, starting with YERN and insurance failure.
Yes. Premier Insurance Company Limited, Gibraltar-based motor insurer, operated in the UK. It's entered administration.
Okay. What does that mean for policyholders?
Well, policies remain in force for now, but they aren't renewable. Crucially, FSCS protection applies,
Right.
but only covers 90% for first-party comprehensive fire and theft claims. So customers really need to sort out alternative cover pretty quickly.
Good to know. And on a more positive note, some action against fraud.
Yes, a major international joint action. UK and US jointly sanctioned a big online fraud network, operating illegal scam centers apparently in Southeast Asia.
And the result?
Immediate freezing of UK properties, including, get this, a £12 million mansion in North London, presumably bought with the proceeds of these scams.
Wow. Good to see some enforcement action there.
Definitely.
And finally, just a few quick fire mentions to round things off.
Sure. The FCA's $101 million Blue Crest redress scheme is ongoing. There's still that consultation on reforming the Senior Managers and Certification Regime, the SMCR.
Well, it's still important.
And regulators are also simplifying capital requirements for investment firms. So a few other moving parts there.
Okay, great. Right, let's quickly recap the three main takeaways then for you, our listener, working in risk and compliance this week.
Okay, first, the new speed and scale of that remuneration liberalization from the PRA. Dramatically cutting rules, remember, by 70%, aimed at boosting competitiveness.
Second takeaway, the non-negotiable operational intensification mandate. Think of that huge £14 million cyber fine for Capita and those chilling failures in detecting hundreds of romance fraud payments. That pressure isn't going away.
No. And third, the cautious ambition driving future finance. You see that clearly in the proposed £10 to 20p holding limits for stablecoins and also in the stalled Revolut banking license. Regulators are definitely hedging their bets on digital growth.
Okay, so to leave you with a thought for the week ahead, given the IMF's pretty explicit warning about the AI stock boom mirroring the dot-com bubble, how should you, in retail banking, balance that essential investment you need to make in new AI-driven fraud detection systems? With the risk of building tomorrow's critical infrastructure on tech valuations that could potentially collapse?
That's a difficult question, isn't it? But an essential one. It really means risk teams need to constantly review their infrastructure investments, not just their fraud protocols or compliance checks.
A tricky balancing act indeed. Right. That's all from us this week. Thanks for listening to RegTalkUK. Until next time, stay sharp and stay compliant.